There is a number following you around almost everywhere you go financially. You cannot see it. You cannot hold it in your hand. Most people do not even think about it until they need to borrow money. But when the time comes to apply for a home loan, buy a car, finance a business, or sometimes even rent an apartment, that number suddenly becomes incredibly important. That number is called your credit score. A good credit score can save you tens of thousands of dollars over your lifetime by helping you qualify for lower interest rates and better financial opportunities. A poor credit score can make borrowing more expensive, or even prevent you from borrowing at all. The good news is this: a credit score is not based on luck, it is based on your financial habits. Once you understand how it works, you can start improving it. So let us begin, right from the very beginning. What is a credit score? A credit score is simply a three-digit number that tells banks and lenders how trustworthy you are when it comes to borrowing money and paying it back. Think of it like a school report card. When you were in school, your teachers looked at your assignments, homework, attendance, and tests to decide how well you were doing. A lender does something very similar. Instead of homework, they look at your financial behavior. Have you paid your bills on time? Have you borrowed responsibly? Do you repay what you owe? Have you taken on too much debt? Based on all of that information, they give you a score. Most credit scores range between 300 and 850. Generally speaking, the higher your score, the better. A higher score tells lenders, this person is responsible with money. A lower score tells lenders, this person may be risky to lend money to. Now, this does not mean someone with a low score is a bad person. It simply means their financial history shows more risk, and lenders are always trying to reduce risk. Why does your credit score matter? Imagine two people walk into the same bank. Both want to borrow $100,000. They have similar jobs. They earn similar incomes. But one person has a credit score of 810. The other has a score of 580. The bank feels much more confident lending money to the first person. Because of that confidence, the bank offers them a lower interest rate. The second person may still receive the loan. But because the bank sees more risk, they charge a higher interest rate. Over 20 or 30 years, that difference could mean paying tens of thousands of dollars more. The loan amount is exactly the same. The only difference is the credit score. That is why understanding this number is so important. It affects how much borrowing costs. It affects whether you are approved. And sometimes it affects opportunities you never expected. How is your credit score calculated? Many beginners think credit scores are random. They are not. They are calculated using several different pieces of information. Let us look at each one. 1. Payment history. This is the biggest factor. It makes up roughly 35% of your score. It answers one very simple question. Do you pay your bills on time? Every month you make a payment on time, you build trust. Every late payment weakens that trust. Imagine lending money to a friend. If they always repay you exactly when they promised, you would probably lend to them again. But if they constantly make excuses and pay you weeks late, you would become hesitant. Banks think exactly the same way. Whether it is your credit card, your personal loan, your car loan, or even certain utility bills, paying on time is one of the most powerful things you can do. Even one missed payment can stay on your credit report for years. That does not mean your score is ruined forever, but it does mean consistency matters. The easiest way to avoid missing payments is by setting reminders on your phone or using automatic payments if available. 2. Credit utilization. The second biggest factor is something called credit utilization. This sounds complicated, but it is actually very simple. It measures how much of your available credit you are using. Imagine your credit card has a limit of $1,000. If you owe $100, you are using 10%. If you owe $300, you are using 30%. If you owe $900, you are using 90%. Even if you make your payments on time, lenders become concerned if you are constantly using almost all of your available credit. It suggests you may be relying too heavily on borrowed money. Most financial experts recommend keeping your utilization below 30%. Lower is generally even better. Think of it this way: having available credit is like having a fuel tank. Just because the tank can hold 100 liters does not mean you should drive around nearly empty all the time. Leaving plenty of room shows you are managing your resources carefully. 3. Length of your credit history. The next factor looks at how long you have been using credit. The longer your positive history, the better. Imagine hiring 2 employees. One has worked reliably for 15 years. The other started yesterday. Who would you trust more? Financial institutions think the same way. Someone who has managed credit responsibly for many years has demonstrated consistency. That is why older accounts can actually help your score. Many beginners make the mistake of closing their oldest credit card because they no longer use it. Sometimes keeping that account open, provided it has no expensive annual fees, can actually benefit your score because it extends your credit history. 4. Credit mix. Next comes something called credit mix. This simply refers to the different types of credit you have managed. For example, a credit card, a personal loan, a car loan, a home loan. Managing different kinds of borrowing responsibly shows lenders that you can handle different financial commitments. However, do not rush out and borrow money simply to improve this part of your score. That would defeat the purpose. This factor is relatively small. Responsible borrowing is always more important than having many different loans. 5. New credit applications. The final major factor looks at how often you apply for new credit. Each time you apply for a loan or credit card, the lender usually performs what is called a hard inquiry. One inquiry is not a problem, but many applications within a short period can reduce your score slightly. Why? Imagine someone suddenly asks 10 different friends for money in the same week. People naturally begin wondering whether they are having financial problems. Banks think similarly. Applying for many loans at once can suggest financial stress. So, whenever possible, avoid applying for several credit products at the same time. How can you improve your credit score? Now comes the important part: improving your score. The good news is that most of these steps are simple. They just require consistency. First, always pay your bills on time. This cannot be repeated enough. It is the single most important thing you can do. Even if you can only afford the minimum payment on a credit card, paying on time is better than paying late. Consistency builds trust. Second, reduce your credit card balances. If your cards are close to their limits, make a plan to gradually pay them down. You do not have to eliminate everything overnight. Small improvements made consistently can have a significant impact over time. Third, check your credit report. Many people never look at it, but mistakes happen. Sometimes accounts appear that do not belong to you. Sometimes payments are incorrectly marked late. Sometimes identity theft creates problems you never knew existed. Review your report carefully. If something is wrong, contact the credit bureau and dispute the error. Correcting mistakes can improve your score without borrowing or paying anything extra. Fourth, avoid opening unnecessary accounts. Every new account creates another responsibility. Only borrow when you actually need to. Responsible borrowing is always better than unnecessary borrowing. Fifth, be patient. This is probably the hardest lesson. Many people want quick results. Unfortunately, building good credit works a lot like growing a tree. You cannot water it today and expect a huge tree tomorrow. It takes months, sometimes years, but every on-time payment strengthens your financial reputation. What is considered a good credit score? Although different countries have slightly different scoring systems, the general idea is very similar. A score below about 580 is usually considered poor. Between 580 and 669 is considered fair. Between 670 and 739 is generally considered good. Between 740 and 799 is very good. And anything above 800 is considered excellent. Remember, these numbers are not prizes. They simply represent how much confidence lenders have in your financial behavior. Can a bad credit score be fixed? Absolutely. Many people believe one mistake ruins their credit forever. That is simply not true. People lose jobs. Unexpected medical bills happen. Businesses fail. Life is unpredictable. Credit scores are designed to change over time. As negative information becomes older and you continue making responsible financial decisions, your score can gradually recover. Thousands of people rebuild their credit every year. The key is consistency. Final thoughts. Your credit score is really a reflection of your financial habits. It rewards responsibility, it rewards patience, and it rewards consistency. You do not need to be wealthy to have an excellent credit score. Many wealthy people actually have poor credit because they manage debt poorly. Likewise, someone with an average income can build an outstanding credit score simply by paying on time, avoiding unnecessary debt, and using credit wisely. Remember this simple rule. Every financial decision you make today is helping to shape your financial opportunities tomorrow. One bill paid on time may not seem like much, but over months and years, those small decisions build a financial reputation that opens doors to lower interest rates, better loan approvals, and greater financial freedom. In the next video, we are going to explore one of the simplest and most powerful investing strategies ever created. We are going to learn about index funds, what they are, how they work, and why millions of everyday investors, along with some of the world's most successful investors, rely on them to build long-term wealth. Be sure to join us.